Hello and welcome to this very special episode of Money View from the Top here on Daily Hunt. Joining me today is Neil Parikh, who is the Chairman and CEO of Parag Parikh Financial Advisory Services Mutual Fund. More importantly, he is someone who's taking forward the legacy of his much revered father, Parag Parikh, and is today one of the fastest growing mutual fund houses, something which was his father's dream, and he's putting it into place. Thank you very much, Neil. It's always wonderful talking to you because I knew your father. I had the opportunity and honor to interview him many times, and it's wonderful to perhaps be interviewing you for the first time. And congratulations on the good growth that your fund house is seeing. So my first question, Daily Hunt viewers, millions of viewers who are watching this would want to actually hear from you, maybe some learnings that you picked up from your father, especially today's youngsters who perhaps may not have watched his interviews, were too young perhaps in school, but could you encapsulate 2 or 3 learnings that you picked up from him, which are relevant, especially in today's times?
So thank you so much, Vivek, for having me over. It's great to be interviewed by you, actually. With my father, most of my learnings have come from him, So he was quite a chatty person, He'd love to chat and love to impart knowledge. So I've been hearing that since my childhood times, So a lot of the learnings have come from him. So let me say 2 or 3 really relevant learnings that are, for me at least, were very important, which we also imbibe in the fund, So that's how we also manage the fund. So the first and the most important one was the law of the farm. You cannot sow something today and reap tomorrow. Just like a seed goes through various seasons, goes through various time and becomes a full-blown tree, our investments are also something like that. We need to nurture them, give them time. So the long-term nature of investments, or the long-term horizon that you need for your investments to really work. So that's number one. With that comes, if you can do that over time well, and if you have the patience to do that, then what happens is you don't work for money, your money works for you, So over time, you're not working for a paycheck, your investments are working for you. That gives you freedom to pursue other things that you might enjoy, hobbies, or spend time with families, or long-term thinking will lead to compounding effects, which can really benefit you over the longer term. Secondly, one of the things he used to say is never chase a fancy. And his saying was, if you chase a fancy, then what you do is you pay a fancy price. When the fancy ends, all you're left with is a fancy loss. So beyond that, nothing happens. So that is something we really imbibe. Is it's very important what you buy and what you pay for that purchase is very important. It's don't chase the herd, don't chase fancies or fads of the market, don't chase the new, until you don't know about it properly. So that's something that's very well imbibed in me and the fund. And thirdly, he said that one thing that he's always used to say is that investing is supposed to be boring. The day it starts turning exciting, realize you're not investing, you're gambling, speculating, trading, and nothing wrong in trading or any of that stuff, but it's important to know what you are doing, so have a focused approach in what you are doing, and hone your craft towards that, so I think these 3 things have really stuck with me, and it's something that we've ran the fund also with these principles. So yeah, these 3 are pretty strong in my head.
Thanks very much, Neil. This is so important for every young person who's listening to this interview. Please do factor this. We'll talk a little bit more about this as we go along. Neil, what is your view on the current state of the market? I mean, because this is a recorded interview, I can't even go into the levels, because if I talk about a level that we are at, and 3 days later, it could be also different. Such volatile times, uh, sharp swings in the market, either way. Uh, what should an investor do? I mean, this is the kind of volatility that would, obviously cause fear. Now, I know in percentage terms, it might be just 1% or 2%, but when you see that screaming headline, Sensex tanks, or, Sensex is up 1,500 points, either way, the emotions run wild. So what should an investor really do in times like this?
Yeah, so I think two things are important to understand here for investors, retail investors, that markets are inherently volatile. They're supposed to be volatile. I mean, ups and down are part and parcels of the market, So periodically we will have these crazy rides of ups and downs. So it's important that we ride through them, because returns from the markets are lumpy. They're never linear. So there will be periods, 2, 3 years where you might not even get any returns. You might get negative returns, but there'll be that 1 year that will take care of the previous 4 years. So and nobody knows when that year will come or when that time will come. So the only thing a retail investor can do is invest with some thought in it. Just don't invest haphazardly. Number one, invest with if you're investing by yourself, then with your investment process, pick up good stocks or safe stocks with margin of safety, or invest through a mutual fund or whatever it is, and ride that volatility. I think volatility is here to stay. I think also the fact that from the COVID lows, we've seen great highs, and again, we've given up some of the gains, but I think Indian markets are acting very resilient right now compared to the global markets. And I think over a medium to long term, Indian markets are poised to do really well. But there will be short-term volatility. Global pressures will be there in terms of the war or inflation or interest rates and the like. So brace for volatility. I think the next 12 to 18 months will be pretty volatile. I think if you can stomach that, I think there's great wealth to be made over the longer term.
Can you explain to our viewers, Neil, how you're reading the interest rate scenario and what kind of an impact it could have on them? As you know, we are still largely, even though we've seen significant growth in mutual funds, but we are still largely a bank fixed deposit society. This increase in interest rates, what does it mean for investors? Especially in debt mutual funds, what kind of benefits now do they offer? Because many people tend to compare with their bank fixed deposit return. Of course, they don't factor in the tax, and they think this is safe. We've seen a few cooperative banks going bust, but anyway, there is a certain sense of guarantee, certain sense of safety, which as a mutual fund you are not allowed to, commit to any investor guarantee. But how do you read this scenario and the situation?
Yeah, so I think we are actually, it's kind of normal times now. Interest rates being positive and being somewhat mid single figures is actually quite a normal normal time to be in. I think the abnormal time was the last 2 years, where interest rates were negative or close to zero or artificially low. That was the abnormal time. I think we are getting back to some sort of normalcy. So I am actually quite okay with it. I think what had happened during the COVID time is that we had lockdowns all over the world. We had lockdowns, and what the governments and the central banks world over did was they would actually give people money in their bank, saying that, listen, don't get out of the house, but just make sure that you have enough money to eat and keep yourself warm and stuff like that. So money was transferred into people's accounts. At the same time, to keep the demand high, interest rates were cut quite drastically all over the world. Some places had negative interest rates where we have never seen any of those things, right? I mean, that was the abnormal part. So demand was high, interest rates were low, and as we opened up, we realized there are supply chain constraints, with China still having some of these lockdowns, and some other countries still having the lockdowns. Also, the fact that the war was there, which increased energy prices, and inflation stoked. And I think the main concern today is how to control inflation. And I think that, yeah, there will be, like I said, 12 months, 18 months more of maybe we could see interest rates hikes. And I think I'm not in the pessimistic camp where I think that interest rates are just going to go up and up, and there's not going to be tomorrow. I think inflation will definitely cool down. I think if it's not already cooling down, I think we're seeing some factors, some commodity prices are already coming down. So I think it's a 12-month kind of a phenomena where you would see some increase in interest rates all over the world. But I think over time, over 12 to 18 months, I think this should also cool down. We should make a new normal in terms of interest rates. And I think once that happens, I think we'll recalibrate ourselves, and I think things will pretty much look up, So yeah, that's the reading on the interest rates.
Neil, since most of Daily Hunt users are very young people, can you explain to them the power of systematic investing? We've seen fairly strong inflows into SIPs even during the last 2-3 years of COVID, and that's very encouraging. We're clocking 12,000 odd crore a month. First of all, do you see that trend continuing? You travel a lot, your teams are traveling a lot, meeting people across the country. And more importantly, for somebody who wants to invest and you're young, what is the power of systematic investing, if you could explain that?
Sure. So I'll take that in two parts. One is the SIP, and how do I see it, and if it's sustainable, the SIP growth. So in my views, I think the equity culture in India is just about starting. I think only in the last 8 to 10 years have a lot more people come into the markets, and have seen the power of equity investing. So I think we are still pretty new. We're still scratching the surface as such, So we're not like a really matured market or anything. So I think the runway ahead is huge. Secondly, we had demonetization in 2016, and that led to the financialization of savings, in the sense that people move from hard cash, real estate, gold, to actually investing in productive assets like stocks, bonds, mutual funds, etc. So that's kind of been like the last 6-8 years. So and in fact, I was meeting a few people the other day, and a lot of people, majority of people, SIPs are now 5 years, 7 years. They've been investing, and it's been like 7-year journey has happened now. And in that 7-year journey, if they see their returns, they're really happy, and the experience has been really great. I think with that good experience, confidence will come to make more investments, make more SIPs. Word of mouth marketing will be good in the sense that if people have good experience, they have been telling other people, listen, I did a SIP over 7 or 8 years, and this is kind of the returns I'm getting. So people are like now seeing real, instead of just the gyan that mutual funds and all used to give, power of SIP, people are actually seeing over a 7-10 years that SIPs are working and they're doing a great job for you, So I think going forward, SIPs will continue to be strong. Also, the fact that during the COVID lows, I think a few people I have spoken to about this, and the interesting part is during the COVID lows, again, the thought, and I talked to a lot of people, oh, should we not invest? Should we stop our SIPs? Should we take out all the money from the markets and all those things? Obviously the fear was the strongest at that time. And in fact, that's the time to actually invest, right? When the fear is the highest. And it's very hard to it's easier said than done, that invest in market lows and sell at high, buy low, sell high. it's easier said than done, but not many people can actually do it. When the time to take that decision is comes, many people are not able to do it. But the SIPs have helped them. A lot of people who had kept their SIPs running through the pandemic lows are really seeing those investment really doing well for them now, after 2 or 3 years. So I really do feel that we are just starting the SIP culture, and I think there's a long runway ahead. The benefits of SIP are two. One is rupee cost averaging, and one is the discipline of investing. Rupee cost averaging is nothing but if the market falls and the net asset value of the fund falls, then for that same amount of your SIP, you will get more units of the fund, and vice versa. If the markets are on a tear and and the NAV has really risen up, then you'll get a few units of the thing. So in essence, you're pretty much timing the market by not timing it. So it creates that discipline of just being invested. You take the advantage of the lows, which is the most important. Like I said, during the COVID time, it was hard for people to put lump sum money in, but the SIPs, because they were working, then they were going automatically and they were not touched. They really provided that CAGR, or the compounded returns, to the investors. So I think the benefits are, it gives you the discipline, and it helps you to accumulate units at lower prices, and more of the units at lower prices, by not taking any decision. So the decision making is already handled. So that discipline really comes in handy, and I've seen that firsthand over the last few years, how that discipline has really helped investors.
Neil, you talked in the beginning about investing versus speculating. If you see the last 2-3 years, while we've seen, very robust SIPs being opened, people coming in and investing in mutual funds, but we've also seen perhaps a little more of direct stock trading accounts being opened. We've seen millions of cryptocurrency accounts being opened, and we know where all that has landed up with young people. Would you want to reiterate, why, if you do not understand a particular asset class or a particular, mechanism of, trading or the risks involved in trading, stay away from it and kind of, make sure that you are there in a regulated place? Can you explain to our viewers, adding on from what you said in the beginning of this interview about investing versus speculating?
Sure. So I'm not against anyone trying to do this by themselves, but you have to realize that investing, or that matter, even trading, is a full-time job. It's a full-time job. It requires time. It requires dedication. You need to give it a lot of effort. You need the right tools to the right strategy, trading strategy, or you need a robust research process and tools with that to do a proper research. If you are able to do that, you're able to give it a lot of time, then by all means do it yourself, and you can become proficient investors. I have no problem with that part of it. The problem arises when you open Demat accounts and haphazardly start investing without a thought, without a plan, without a procedure, without a strategy. I think that is a recipe for disaster. Again, today on social media, you have a lot of these people giving free gyan and free tips and all that. You hear out in the open, in cocktail parties, people giving free tips and all. I think those are the things to really stay away from if you don't understand it. And if you really want to gamble away your money, then I think you should probably go to a casino. I think there you'll at least have fun, and you'll get a couple of drinks also while you're at it. So so if you want to really gamble your money, then go bet on cricket or go to a casino and keep that money aside to gamble away. But if you think you are investing or you're trying to make money here by doing these things, then that's not going to happen. I'll be very honest that this doesn't happen. You can get lucky once, but 9 out of 10 times you're going to lose money. Better than that is to look for some advice. Go to a good financial advisor, get some advice. If not, then even go to a invest via mutual fund through an SIP or something like that. I think you'll be better off. So have a plan. Actually, most important is have an asset allocation, have a plan in place about why you're investing, have financial goals. Once you put that in a paper, then you can actually get some help. Or if you're good enough to do the research by yourself, then you should. Then that's also fine, But keep these things in mind, because it's a recipe for disaster. And you've seen, and Vivek, you must have seen a lot more people than I have who got burnt with just working on tips or just haphazard buying of the new, as they say, chasing fancies, like I first said in the beginning. I mean, crypto and all, if you don't understand, then just stay away from it. Don't chase the fancy.
Neil, if I take a 3 to 5 year kind of a horizon, are your fund managers bullish on the equity markets? Do they believe over a period of the next 3 to 5 years, there is good returns to be made?
Yes, I think over a 5-7 year period, I think we are pretty bullish on the markets, Indian markets especially, and certain pockets of the foreign markets. So the things that we are bullish about, and where our investments are even right now, are private sector banks. I think we're bullish on the private sector banks. I think private sector banks are obviously the NPA stuff and the COVID related issues are all behind us, and they've come out very well after that. But valuations are pretty decent. Also, the fact that they've been taking market share from public sector banks on a yearly basis, we think that private sector banks will have a good run going forward, and we are pretty positive on private sector banks. Autos is another industry that we are bullish on. I think demand revival has come back after 5 years of pretty much not great returns as such, But I think going forward, autos presents a good opportunity going forward, So autos is one. We are very, very excited with the mature tech space in the in the US, like the Googles, Microsoft, Facebook, Amazons. Unfortunately, we're not allowed to invest in that right now because of the RBI limits. But I think if the RBI limits were open, I think that's another place you would really be looking at, because the valuations are just mouth-watering right now. There. So that's another space we are excited about. We also like the IT sector in India. I think going forward that will do well. And some capital market companies like exchanges and depositories are some of the things that we like going forward.
Thank you very much, Neil, for taking time out and sharing your perspective with our viewers here on Daily Hunt. Thank you once again. And it's been wonderful talking to you. And I look forward to many more conversations with you, and wish you all the very best in your journey of taking forward your father's legacy. Thank you.
Thank you so much, Vivek. I appreciate you interviewing me. And yes, we'll have many more interactions going forward. So thanks again.
Thank you, Neil.